Hello, hello, advisors of Earth. How are you? Very excited for this conversation today with John Phoenix. We're going to be talking about one of, if not the single biggest decision a financial advisor will ever face. Should you sell your business? Or in this case, we're selling practices. We're not even selling businesses. But if so, how do you do it? How do you do it right? Today, I'm joined by John Phoenix. John is a founder and partner at Wealth Advisor Growth Network and a longtime advisor advocate. Today, we're going to be unpacking the real trade-offs behind the M&A deals, the rise of private equity and wealth management, and the very costly mistakes advisors often don't see until it's too late. So whether you are thinking about a sale in the near future or you're just trying to build out your RIA the smart way, stick around. But first, a word from our sponsor. Today's show is brought to you by our sponsors at Betterment Advisor Solutions. If you happen to be thinking, there's got to be a better way to grow my RIA, you're not alone. With Betterment Advisor Solutions, we do the heavy lifting so you can focus on what matters most, your clients, from improved service that makes asset transition smoother to fast paper-free onboarding that delights clients on day one. They've built a digital-first platform designed to streamline your operations and make life easier. If you're thinking, wow, they take the paper out of paperwork, that's right. Grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk. Performance not guaranteed. All right, John Phoenix, welcome.
Good morning, Michael. How are you?
I'm doing great. I am truly excited about this conversation because you call it like you see it. You are out there throwing flames at some of the shenanigans, some of the nonsense that we see. And oh boy, is there a lot of it. So I want to start this conversation off by a story that I saw last week that I said, wait, what? All right, John, throw this up, please. This is real. It looks AI generated. It's not. $800 million UBS team joins Morgan Stanley for the third time. What? John, please, what is happening?
You know, I don't know, honestly. It is confusing. I try to call it out every time I see it. That team specifically going from UBS to Wells Fargo, it's like jumping out of the fire or out of the pot into the fire. I did the math out on that team versus a payout they probably received joining Wells Fargo versus going independent. And it's like a $50 or $60 million difference in terms of enterprise value. I think a lot of these guys are brainwashed in terms of it's too hard to be an RIA, or I'm scared of the compliance. I don't understand the tech, and they don't understand how far our side of the business has come and how easy it is to run your own business. So it's a shame.
Could you imagine telling a client, hey, we're going back. We're going back to UBS. It wasn't good the first time. The second time was a little bit better, but I had to leave. But the third time, I promise you, the third time's the charm.
This is it. I got a bunch of paperwork for you to sign. You get to go back to that wonderful technology. It makes no sense to me.
Unbelievable. All right, let's put some numbers on this. So on LinkedIn, where you throw a lot of your flames, you said, I get why you would exit UBS. I'm sorry. I get why you would exit UBS, but why on earth join another company so riddled with issues? Let's do some math. My bet is these guys got $30 to $40 million on a 9-year forgivable note. So they are netting $15 to $20 million, as this would be taxed as ordinary income. Let's pause right there, please. What is exactly a 9-year forgivable note? What does that mean?
Yeah, effectively, they're getting a payment up front. That $30 or $40 million comes to them as a payment up front. They are obligated over 9 years to stay, and it's a forgivable note. So effectively, if they stay 9 years, they get to keep the $40 million. If they leave prior to that, they'll own part of that note back, depending on their kind of vesting schedule on that note. Also on that article, this one, it was UBS to Wells Fargo, right? So that's the one that really confused me because, you're going from, UBS to Wells, you're going to that, first clearing custodian. It made no sense to me. So, but the forgivable note is also taxable at your income tax rate. So, you're owed a big tax rate, you're stuck there for 9 years. It makes no sense.
Yeah, but on 9 years and 1 day, we know what happened. So you also said, all right.
Would you go back to UBS?
A firm this size in the RIA space would get a multiple around 13 to 14 times EbOC. So $11 million in revenue. John, what's EbOC for people that are unfamiliar with the term?
They just try to normalize revenue in the RIA space. It's earnings before owner's comp. So they're trying to get a apples to apples comparison in our business, kind of like EBITDA, but we do EbOC in the RIA space. So, this practice, as I said, that 13 or 14 times would equate to, almost, if we do it at 11 million in revenue and a 40% margin, and most of our RIAs are running north of 50% margins, at a 13 to 14 times, the values of practice between 57 to 61 million bucks in our space. And these guys took a $40 million check, got 20 million. They're leaving literally tens of millions of dollars on the table.
All right, so I want to come back to that, to the math part of it, but talk about, so you've been in this for a long time. You were at Envestnet, one of the giants in the space. You know the ins and outs of the RIA industry, the IBD. Like this is very much what you eat and breathe. Talk about the multiple expansion that we've seen over the decades. You must be floored that people are getting the numbers that they are, the multiples that they are.
I was part of I own part of a $900 million firm in the early part of the 2000s. And I was with an older advisor who was the majority. We had to sell the business because of his age. We sold it to a bank. They were the roll-up players back then. And we got 8 times. And we thought we had hit the home run of all home runs. Private equity kind of entered the space 12, 13 years ago. And since then have been driving up valuations. More recently, we've gotten 2 new buyers into the space with the entree of the sovereign funds. Singapore came in and purchased a part of Mariner, and Abu Dhabi bought CI from Bain
and Fisher.
Yeah, and Fisher, and now you have the asset managers diving in, right? You have Neuberger buying, you have BlackRock buying, starting the big funds. You have, usually in the private equity deal, it's kind of changing seats, and that you don't want to get caught when the music stops in that game. But with the addition of the 2 additional kind of buying powers, you have 3 entities competing in our space to buy very few properties. So, and I just want to say on that, if you look, there's 28,000 RIAs today. There's roughly 220 over 5 billion or 2 billion, and there's roughly 90 over 5 billion. And of the 90 over 5 billion, I think 87 are institutionally owned. So there's not much for sale either. So you got
not us
buyers. You're not institutionally owned. That's awesome.
We're one of the few. All right, I want to come back to the why are these advisors not going the RIA route, but I want to talk about a 4th entrant into this very, very competitive race, bidding war.
Right.
And these are the digital RIAs, the ones that are very healthily backed by venture capital.
Right.
We were talking to an advisor. I'll tell a story. Obviously, I won't divulge any names or anything like that, but we were close with a couple of advisors, and we don't write paychecks. So the advisors that join us, there's plenty of reasons why they make the decision to do so, but money is one of them, and I don't begrudge anybody. I'm a capitalist myself, but we were close to getting a deal done.
Right.
And then the company that they were about to leave got purchased by another company, as happens all the time.
Right.
And they were understandably so afraid of litigation. I get it, believe me. And so they opted for an offer that we couldn't match. I don't know how anybody would match this offer. I don't know how the offer got made, but here's what they got. They got a signing bonus. I forget what it was. They got a 90% guaranteed payout at like 95% of the assets that they had, not that they brought over, that they had.
Okay.
They got an executive assistant. They got shares in the company, and they got full indemnification should they be sued. And I said, God bless. Unbelievable.
Yeah. It's a great time to be an advisor. Those kind of situations, you run into a lot of those. It's definitely a bidding war out there. Was it a BD they went to?
I don't want to say.
Yeah, it's crazy the amount of money out there. I've swung and missed at a lot of firms as well, but that's awesome for the advisor.
I think probably like you, the way that we think about it is the people that are with us that stiff arm a lot of this nonsense are here for the right reasons, and those are the people that we want to work with. And I think we are starting to see some of the fraying. This is not a new story. These institutionalization of the RA space has been underway for the better part of the last decade. And there's a lot of people that did not get a lot of great deals, that were left with their senior partners, that didn't have any equity, that are now part of the bottom lineization of this industry. And they're starting to say, hey, wait a minute. I don't know that I want to be a part of this.
It's interesting because you're starting to see, breakaways from the breakaway firms.
Yeah.
Right. We helped a $2 billion firm in California leave a Midwestern roll-up firm. They had left Wells Fargo. They used an intermediary because they were scared to death of compliance and tech and IT and all the payroll, all of those things. And about 2 years in, they realized that they were paying enormous amounts of money to this intermediary. So what we're doing when we're helping people leave is we're trying to emphasize the importance of having direct contracts with all your vendors, your custodian, your tech, your asset managers, everybody direct, to try to eliminate that middleman. On that team, we uncovered $631,000 of non-compensatory revenue.
Wow.
That the firm was earning primarily off the backs of their clients, but also off the advisors as well. So, everybody kind of scares these new entrees that how hard it is. But as you said, it's been institutionalized. The players in the space, you can outsource darn near everything. And what you really need is just help finding the vendors to set up the firm correctly, and you're off and running. But
yeah.
We're doing a lot of. We launched a firm where we're helping a bunch of folks come together, and take advantage, because you bring up succession is the issue right now.
And give a plug. What's the name of that new company?
It's Uniting Wealth Partners. We started it a year ago, or 8 months ago. And the idea behind it is simply, you've seen the aggregators bring all these advisors together, and they're generally powered by a PE firm, right? And the advisor gets a decent multiple when they join, but the real money's made when they roll all those firms together and then sell the larger entity. And so PE, or the institution owner, is financially engineering the advisor. So effectively what we said is take one step more in your succession plan. First, aggregate with your peers, with other advisors, and get big, get the higher multiple when you sell. So our aggregators are a little different in the fact that we own part of the advisors that come in. We buy 20% stakes in them. And then the advisors own 60% of the aggregator. So they are the majority owner of their own practice, and they're the majority owner of the aggregator. And then at sell time, they get the multiple on their own practice, the higher multiple, and they get the multiple on the share of the holding company they own. So, a little bit different approach, but again, trying to advocate on behalf of the advisor and trying to get that middleman out between them and their final exit. So
that sounds a lot better. It sounds a lot better than being beholden to the majority owner who is ready for retirement. It says, sorry, my company, my stock, I'm finding a buyer. It sounds like you're creating a better approach. John, I want to get back to the advisors that grew up in the Wirehouse channel, the IBD channel, that you can't not be aware of what's happening in our space, but they're pressing the easy button. They know what they know. It's comfortable. Listen, you mentioned earlier these dinglings that are going to that are leaving UBS and going to another space. They left $20 million on the table. Dude, $45 million or whatever it is, whatever they're getting, it's a lot of money. And so I understand that point of view. It's like, listen, 45 million, 60 million, what is literally the difference? I am a very, very wealthy person. I don't want to take the risk of the unknown. I don't know about compliance. I don't know about a tech stack. I don't know about all of these different things that I'm getting baked into my practice at the Wires or the IBD or wherever they are. What would you tell somebody who is just not even considering the RIA route?
The moving from one BD to another is complicated, right? You're going to have to repaper. You're going to have to go through that whole process. You're going to a new firm where your compliance is dictated by the lowest common denominator. So, you go to LPL, there's 29,000 advisors, they're having to do compliance based on the lowest common denominator there. So you're being dictated a lot to those. You're captive to their custodian, right? You're captive to their technology. You now have a new branch manager that's telling you what to do. What I would say to them is they don't know how good it is on the RIA side to be truly your own boss, to be able to truly pick your own products, to eliminate that middleman that's doing cash sweeps and manager sharing. It's good for your clients. It's good for you. The fear of compliance, you can outsource compliance entirely if you want to. The fear of tech, the tech will improve your life dramatically in the independent space. It's easier to manage accounts. It's easier for your clients to see their reports. You can aggregate assets from all over the place. Maybe 15 years ago, we were behind in the RIA space from tech and product standpoint. But I would say, we crossed over 15 years ago, and now the tech's better, the product access is better, and the freedom is unbelievable. And plus you're building enterprise value that is being, monetized by lots of people in the RIA space to the tunes of, at a $5 billion or $2 billion firm, it's, $5 billion firms are trading 16 to 18 times. I don't know if you saw that CW acquisition yesterday. They're paying them on a $14 billion firm, $850 million. That's 18 and a half times EBITDA
Lord.
on that trade. So it is, I just think that the enterprise value versus the upfront check and the comfort, it makes no sense to me that you would go that route.
All right. So I'm very curious how a lot of this money finds an exit. The company I mentioned earlier that was giving that insane package, like what's their game plan? How does this fund get an exit? That's a different conversation for a different day. I want to stay with the advisor side of this. Here's one thing that you can outsource, or maybe you can. Running a business. It is very, very different being an advisor and dealing with your clients and dealing with your CSA and whatever you have to do versus setting up your own shop, calling the shots, creating a culture. Now, maybe that's where Wealth Advisor Growth Network comes in, but it's not the same. Running your business is a whole different thing.
Yeah. My partner and I, Jay Hummel, we've been in the breakaway space essentially the last 20 years, and have done hundreds of breakaways. When you're coming over into the independent space, there's a lot of responsibilities that you did not have at Merrill Lynch. Doing your books and records, right? Running QuickBooks, paying taxes on the business, setting up your compliance infrastructure. But in all of those, like on our firms, our main focus is saying the advisor's most valuable resource is their time. And the way they create value in their practice is spending time directly with clients or finding new clients. So in our firms, we outsource the CFO slot. We outsource the compliance slot. We outsource the technology. We outsource the middle, back, and front office. So you have support in all of those. So in our firms, it almost feels like you're in that broker-dealer wrapper with the back office. You have a team supporting you. Your SA or your sales assistant is working with them to manage your accounts. So it has a very similar feel. And what your responsibility is to review your billing at quarter end, to review your taxes at year end, but most of that's prepared for you. So you can really set up the business. The examples I'll give you is like in Elk River in Denver. We did that from, they came out of Bank of Oklahoma, run an unbelievable practice today. They're approaching $1 billion. They left at $360 million 5 years ago. Naviter Wealth in Little Rock, again, left Stevens. The those are great examples of guys that cannot believe how great the RIA space is once they get out from under the kind of the mythology that is created by the owners of those BDs to try to scare you into staying there.
All right. Huge news a couple of weeks ago. LPL swallowed Commonwealth. And I can't believe it, John. You had some thoughts. You put on LinkedIn, will keeping the firm intact. So the CityWire headline was exclusive. LPL CEO promises to keep Commonwealth culture, swipes at rivals. To which John said, will keeping the firm intact allow advisor to keep their client's custody at Fidelity and continue using the Commonwealth technology? When you pay 20 to 23 times for a firm, the only way to make the math work is to consolidate costs and retain advisors. The retention plan seems to be to tell the advisors that nothing will change. If you believe that, I have some ocean property in Arizona I would like to sell you. So what is going on here? What's the bullshit?
Well, the bullshit is you look at Commonwealth, they're all custodied, or the majority of them at NFS, right, on the BD side of Fidelity. LPL has their own custodian. They're telling the press that this is going to stay separate as a separate entity. As we've seen from their prior consolidations, they tend to let go most of the operation staff. They're consolidating by trying to drive up margins on that business. So this will be no different. You'll see the consolidation happen over years. They are saying all of these things because all those brokers have to make the decision kind of right now as to whether to stay or leave. But eventually they'll all be custodied at LPL and they'll all be using the LPL technology. The Commonwealth brand, like all the other brands that were assumed by LPL, will go away. So, and if you don't think that's going to happen, when you pay that much money for something, they have to have a return on investment. The only way to do that is to drive down costs.
Okay, so another twist in the story is Satara offers 150 basis points to Commonwealth advisors in recruiting crusade, to which you wrote, this is hilarious. Satara Financial Group, who is a private equity-owned IBD, presenting themselves as the independent white knight. What Commonwealth advisors and their clients get for those 150 basis points are higher fees, captive brokerage custody, allowing hefty manager fee sharing, and juicy cash sweeps. These fees are taken from the advisor's clients and are, of course, non-compensatory. Beware of the wolf in sheep's clothing. If you want to control your destiny, build enterprise value, and serve your client, call me and go RA. Now, obviously, this is self-serving, but it's obviously true.
Yeah. I think my challenge with a lot of these IBD firms is they're presenting themselves as RIAs. We're independent RIAs, come join us. And they're not, right? They're BDs. They're under FINRA. They're under best interest, not fiduciary standard. And, what that allows them to do is, in Satara's case, is move the custody to NFS or Pershing on the broker-dealer side, and then they can get percent of the cash sweeps. They can put the manager fee sharing on there. If you look at the LPL numbers, I think of gross profits on their most recently quarterly earnings, gross profits were 60% cash sweeps and manager fee sharing. The bottom line is they're taking that off your client's back, and it's not fair to the client. It's not fair to the advisor to print it that way. So, I do tend to challenge those because going independent, owning your own firm, allows you to eliminate a lot of that conflict. There's still conflict on our side. Fidelity and Schwab do cash sweeps. They have lower rates. There are issues there, but there's far fewer when you are closer to the client and don't have that intermediary that is feeding off your client in those situations.
Now, as from the client's point of view and what they're hearing from their advisor, it is far different for the advisor to jump from UBS to Wells, to UBS to Wells, and back and forth. God knows what they're saying to their clients, but that's far different than the advisor who works at Commonwealth, who is being swallowed up by LPL. Yeah. So I don't really know what the question is here, but from the client's point of view, are you surprised that more clients don't elect to eject out of these situations?
most advisors don't understand what's happening. Let alone the client. The client doesn't understand that, their cash is only earning them, under 1%. Why is that? The clients don't, for the most part, don't get it. And I think that, again, that's the advisor's responsibility to take care of that client and put them in the best possible situation they can. So it's hard to get advisors to understand a lot of the nuance of what the broker dealer is doing and how they're making money. So no, I don't. I think the clients don't vote with their feet because they just don't know.
Yeah. All right. In obvious, not conflicts here, but where the rubber meets the road, you wrote, so there was an article in
You're really bringing up. I saw these posts and I looked at them. I'm like,
hey, these are yours.
I know
these are yours. You said it. So Osaic in the pay fight. This is from Investment News.
Yeah.
You wrote, this is priceless. CEOs duking it out over dollars that have been paid to them by advisors who willingly participate as the financiers of this lunacy. Dan Arnold making $80 million a year is beyond comprehension. Yeah, it sure is.
Well, I mean, you look at all that, and where's he making that 80 million? He's making it from his advisors, and he's making it from his advisors' clients. And that's the middleman. That IBD BD relationship is broken because effectively by becoming an RIA, you're pulling all of that middleman infrastructure out of it and eliminating costs that you can share with your clients and share with yourself in the form of revenue. I just don't understand why you would tolerate that. Be part of an organization where you see these egregious pay packages that are being paid off the backs of your clients, off your back as an advisor. So I find it egregious. And there's such an easier way to run the business, such a better way to run the business that, if you're at a BD and you're hit by a bus, your family effectively has only buyers at that firm can buy your shop. And in a lot of cases, it's at one or two times. This goes back to the cobbler's son has no shoes. These guys spend hours and hours and hours taking care of clients, making sure that they are setting up their trust, their estate plan, their succession, all these things. And then they have a practice at a BD where their succession plan is so limited and puts their family in such jeopardy if something happens to them. I'm baffled by it.
Yeah, I mean, I understand from the point of view. You're nothing you're saying is not accurate, but
Right.
From the advisor point of view, it's like, listen, I'm getting 90 cents on the dollar. It's a name brand. My clients know who they are. Like, we're in good hands. The tech is not great, and we're moving slow, and it's annoying. And
but 90 cents on the dollar, Michael, is it? Is it 90% of 50%? It's, the payout thing again. When you put pencil to paper, when I hear somebody say, I have a 90% payout, I'm like, really? You
So
pay
say
for
more.
your office space? Do you pay for your staff? Do you pay for your assistants? They're looking, they're not looking at it through the lens of owning a business. They're looking at it, so they're getting 90% of a much smaller portion. I don't think if you ever run the math between an RIA and a BD, the payout's always better at the RIA because you eliminate the middleman, right? There is no payout, right? You look at an RIA, you should be running an RIA kind of north of 50 margins. That equates to a lot better financials. If you do nothing and you go from BD to RIA, your financials will be a ton better for you and your client. And I'll challenge any BD to that.
Okay. All right, John, where do we go from here? Do you think that the RIA channel will surpass the BD channel in terms of assets? Do you think that there is going to be further consolidation, further fallout, advisors getting pissed off? Like, what do you think the future holds for our industry?
I think the RIA business, it always cycles through these. People are saying, the RIA business is consolidating, and to an effect it is, but it's still growing. I think we added 8,000 new RIAs last year, so it continues to grow. You do have consolidation in that with the mega practices, the Mercers, the Wegs, the Edelmans, the big boys, the Mariners. I see just like when you had consolidation with the banks buying a lot of RIAs, I see the cycle continuing. As you said, these younger G2 advisors did not get a bite of the pie when the consolidation occurred. I think you'll see a lot of breakaways from those large firms. You're already starting to see it at some of the large aggregators. You see the lawsuits flying around. So, I think our model is better. I think it'll continue to grow. I think there'll continue to be advisors that move across the threshold from BD to RIA. And I don't think the multiples are going down in the near future with the competition to buy these firms.
All right, John, we're going to leave it there. On behalf of the advisor RIA industry, I thank you very much for your advocacy and what you're doing, and keep fighting the good fight and saying it like it needs to be said and calling out the bullshit. If people that are listening in the space are considering making a change and they want to learn more about your services, how do they find you?
I'm at www.wagn.biz, B-I-Z. And I'm also via LinkedIn. I have all my contact info on LinkedIn. So please, reach out if you have any questions. And Michael, to you and Josh, what you guys are doing with Future Proof and with your business is phenomenal. You guys have really changed the industry for the better. And it's great to see all the great things you're doing with the industry.
Well, following your lead. Appreciate it, John. All right, everybody. Thank you for watching. We'll see you next time.
Take care, man.